Ladies and gentlemen, good afternoon, and thank you for joining us for this webinar in collaboration with Tamimi Company. Today we'll be talking about the roadmap to IPO and Nasdaq Dubai's growth market for SMEs. Joining me from Tamimi are Andrew Tarbuck, partner and head of capital markets, and Anna Robinson, senior associate capital markets, both of whom we've been working very closely with, not just on the growth market, but general expansion of the capital markets here in Dubai. Thank you for joining me.
Thank you, Tahir. Thank you for having us.
So we'll start with the presentation. We'll be going through a brief introduction around the firms, the growth market, and we'll be looking at the process and the benefits of doing an IPO. We will, following the presentation, be answering any questions. If you have any questions, please do post it in the Q&A box as opposed to the chat box. So let me start with a quick overview around Dubai's capital markets. As you may be aware, we have two exchanges here in Dubai. You've got Nasdaq Dubai here in the DIFC and Dubai Financial Markets onshore. The key differences between the two exchanges, two stock exchanges, are Nasdaq Dubai is regulated by the Dubai Financial Services Authority, and DFM is regulated by the Securities and Commodities Authority. Both regulators have slight different regulations, which gives issuers benefit of wider choice of regulations they can follow here in Dubai. Now, what we do have is a combined liquidity pool on the two exchanges. So we've got investors from over 100 countries trading on the two exchanges. And as an investor, you can use your same broker to trade on both DFM and Nasdaq Dubai. So all the leading brokers are connected to both exchanges. From a quick overview on the key figures, the market capitalization of the two exchanges over $200 billion. Since 2014, we've attracted more than $123 billion to the capital markets here. Last year, we saw an increase of 38% in the traded value compared to 2018. We are the leading international debt listing venue in the region with over $90 billion worth of bonds and sukuk listed onto the two exchanges. And we are the first regional market to offer regional equity futures. That's a quick overview on DFM and Nasdaq Dubai.
Thank you very much, Tahir. Good morning, good afternoon, and good evening, wherever you are joining us from on this webinar. I think, first of all, I'd like to thank Nasdaq Dubai for inviting us to join in and participate in this webinar. But it's actually more a much wider concept, which is really around supporting the capital markets in the UAE. And one of the things that's bringing us together, particularly today, is around the growth market that Nasdaq Dubai has launched. So I think we're particularly pleased as a law firm. Always we're agnostic as to securities exchanges, but we're very, very supportive of Nasdaq Dubai, always have been and always will be. And I think this is certainly a development that's particularly exciting, and I think it's much worth in talking about it today. Tamimi is the regional law firm in the Middle East, and we have 17 offices spanning 9 jurisdictions. So pretty much the widest coverage of any law firm in the region. But the capital markets team, and Anna is a senior associate in our team. We cover IPOs from companies out of the Middle East, from companies coming into the Middle East, and really have that sort of inside knowledge and understanding of the regulators and the stock exchanges. I think obviously our ability to work in the Arabic language and understanding of civil law and common law procedures, it really does help. But it's always challenging, the legal and regulatory landscape for any IPO, and it's a huge part of it, and one that we're particularly familiar with. I've personally been in capital markets in the region for 13 years now. And Tamimi is a law firm, I think can probably say hand on heart, it's the vast majority of IPOs have involved the law firm. So recently we did the Orascom construction dual listing and on Nasdaq Dubai and various share backs for BLME. So we've got some great experience of working with Nasdaq Dubai, and this is another further development that we're closely working with you guys.
Excellent, thank you. When it comes to one of the key things that issuers look for on which exchange to list is investor access, because doing an IPO is a matter of accessing investors. And one of the misconceptions we hear from companies is the fact that when they come and list on a regional exchange, they're only getting access to your local or regional investors. And this is a misconception, because what we've done, we've taken a snapshot of one of our listings to see where investors are coming from. And as I said earlier, we've got investors from over 100 countries. And for this particular listing, we had 37% of investors coming from Americas, 30% from Europe, 27% from Middle East and Africa, and 6% from Asia Pacific. So this truly shows you that investors from all around the world are connected to our market over here. And not just investors, when it comes to issuers as well. We've got issuers from US all the way to China that have listed their securities on the exchange. When it comes to who invests, you have all the leading names from around the world that are trading on Nasdaq Dubai, and these are through your leading brokers here in the UAE, as well as some of the international banks that are connected directly to the exchange as well. And one of the key things when it comes to IPO is visibility, and this is what we at Nasdaq Dubai really work with our issuers to give that global visibility through the Nasdaq network and through our brand, where we'll do various events both here in Dubai and all the way to New York to really provide that global visibility to our issuers. Now, if we quickly move on to the growth market, back in April, the DFSA issued the regulations for SME listings, and on the back of those regulations, we've been working on the growth market, and that's where at the end of October, you would have seen the announcement by the Crown Prince, His Highness Sheikh Hamdan, on the growth market itself that we're working on launching next year. And why have we taken this step to launch the growth market? Well, when you look at the sort of growth stage of companies, starting right from the early days as a startup, all the way to that really developed stage where they're ready for an IPO, companies think that you need to be a very large organization to IPO. You need to have a large balance sheet, strong financials, high levels of profits for you to be able to go and IPO. And that's something which is actually not true. And that's what we're trying to show through the growth market, that you don't have to be very well established and a large organization for you to be able to IPO. One of the other things we've been seeing recently over the years is companies have been coming to us, and these are SMEs who have been finding it difficult to raise finance, whether that's financing from banks as loans, whether that's through venture capitalists or private equity firms. It hasn't been easy for them to be able to access finance from these means. And that's where we've really wanted to try and resolve that issue of SMEs having access to finance by giving them the ability to be able to IPO. And that's where the growth market has stepped in. Now,
I was just going to say, Tahir, it's interesting as well that there's also growth in particular sectors that you're seeing very rapid growth, and you can actually see companies becoming very large very quickly. So it's not that sort of traditional sort of 10, 15-year trajectory. You've got companies that have got a much shorter trading history that are actually growing exponentially, and they need capital and they need access to equity. And, I'm sort of finding, particularly the tech sector is the classic example where, VC now, venture capital, is a much bigger feature in the sort of capital market space, if you like. And a lot of the VCs, they want IPOs and an exit. Obviously VC, private equity, both the same. They will use an IPO as an exit route downstream. And I think that now there is a huge growth in the venture capital scene, primarily backing these tech sector companies. You're finding that they're wanting to get to IPO that bit quicker. So it's sort of, it's at that growth stage, and they're using the capital to actually sort of go with their business plan. And we'll talk about this a little bit further, but one of the great features And the movement that we got from the DFSA and the encouragement from the DFSA is around limiting the trading history eligibility requirement to get onto the exchange. We'll talk about that a little bit later. But I just think that the way that the whole of the sort of the economy is moving, and the proliferation of SMEs in the UAE, which is huge, you know, a lot in the free zones, this sort of opportunity is just perfect, and it's sort of necessary. And you know, it's not in the defensives, it's not in real estate, it's not financial services. This is fintech instead of financial services, and it's I think it's reflective of what's happening in the wider economy and where, you know, particularly His Highness wants to go in terms of being high growth, tech, innovative, disruptive, all of these elements. And this to me fits into that sort of wider kind of 2025 vision and where the economy is going.
And that is very true. You have the ecosystem when it comes to startups. You know, of the past few years, Dubai and UAE has been really working to support startups and bring entrepreneurs here into the country to set up here. Now, they've done well. We've got various accelerators here and incubators, but then if they don't have that support system from the capital markets, the ecosystem is not going to work. And that's what I think we as practitioners in the capital markets really have that job to do, where we step in and we say, well, you've created that ecosystem to attract startups. Now we need to support the growth of those startups. And this is definitely an initiative that we've looked at as that support.
Yeah, I mean, I sort of, I feel that this, you know, this is reflective of the opportunity here. And, you know, there is that sort of, you said right at the start that, you know, a lot of just large companies who've been in existence for a long time see IPO as the next step. But I think the idea is that you've got much shorter trading history companies who've got a mindset of being ready earlier. Because to me, the perfect IPO candidate, whether you're huge, whether you're small, whether you're medium, is just, are you ready? You know, one of the criteria, the main sort of criteria that the DFSA as the regulator will look at is just a suitability to list. And frankly, you know, you are seeing some amazingly run companies that may only be in existence 2 to 3 years, but their attitude to things like financial reporting, disclosure, transparency, corporate governance, they're prepared to do that a lot earlier. And, you know, instead of sort of going through a generation of developing the company and then saying, oh, hang on, we should look at succession issues and we should look at corporate governance and these sort of things, you know, you could get 10 years to get there. And then you say, oh, we're ready to IPO. In my book, once you're ready and you're suitable, it doesn't matter whether you're 1 year trading history or 100 years. And I think what we're seeing is that companies are more ready. And I think that's the thing. And, you know, and if there's one thing from a practical perspective, and we will come into it sort of when we look at the listing process, is very much readiness is the key. Absolute key. If you've got your mindset, you want to do an IPO, start 2 years, 3 years, possibly even, and have it in your business plan right from that start, and sort of work out what you want to do with your business plan on that basis. But get the mindset right, get it done sort of 2 to 3 years beforehand, and then you're ready. You don't have to be 10 years trading or whatever.
Definitely. And look, as part of that readiness, one of the things we've done in the growth market is not just offer that public option, but offer the private market as well. So companies who know they want to IPO in 2, 3, 5 years down the road, but they want to prepare for that IPO, we offer the service for them to join our private market, and that's where we and advisors like yourself can support them in putting all the key pieces together. So when it does come to that time of doing the IPO, they're ready, and it's a lot quicker for them to do that. Yeah. So that's where we also offer the option of the private market. So what we've really tried doing here in Dubai is, through the 2 exchanges, offer a spectrum of opportunities, whether you want to remain private or you've been established for 100 years and you know, very large globally based business, we've got an option for you. And this is where we had that gap of the growth market, and we've plugged that gap in for SMEs who are younger or smaller to be able to IPO as well.
I'm just thinking, if you could go back to that W Motors slide, because W Motors is the case study for that. It's a client that it's a mutual client effectively, but you know, look, you can see the guys on the screen there, and we met them about a year and a half ago now, and they're thinking about, you know, what their next steps are. You know, what's their readiness? What do they need to do? Do they take debt on board, or, you know, do they tap the debt capital markets, or are they looking to equity? And they just thought, right, okay, well, this is a nice, you know, preliminary step into sort of public exposure. And, you know, that is a significant step in preparedness, and it's more about the mindset than anything else. But, you know, that shows you tangibly what's happening, and the exposure that they've got, actually, you know, and the credibility that they will have, even just through the first steps through the private market. And I think that's a good start point.
It is. And one of the discussions we have with companies is that readiness doesn't mean you should only get ready if you want to IPO. It's best practice, and a lot of investors, especially if you're looking to go to VCs or private equity firms, if you have a lot of these you know, key factors in place as a private company that you'd expect from public companies, it gives confidence to the large institutional investors as well, who might be investing from a private perspective. So quickly moving on around to the requirements for listing on the growth market. So where the difference between the growth market and the main market is, any company that's valued at $250 million or below at the time of listing will be joining the growth market. Anyone above will be joining our main market. We've kept the free float the same, so it's 25% free float on both markets. The key change, which you mentioned around financials, is for the growth market, we only require a minimum of 1 year's audited financials, and that's without profitability. So you don't have to be profitable to do an IPO on the growth market, whereas on the main market, it's a minimum of 3 years audited financials require. Corporate governance remains the same. We want good quality companies coming and listing on the growth market as well. And that's where it's important to ensure that you have international standards when it comes to corporate governance. We again require working capital. Investors don't want to see companies raising money to pay salaries and rent and these kind of things. So we'll always ask for working capital reports to ensure there's sufficient money within the business to run the business. One of the things we've introduced is a lock-in period, where there's a mandatory 1 year lock-in period for all current shareholders. And the reason we've done this is because it gives investors confidence that the shareholders who have been a key part of growing the business will remain vested within the interest of the business. So that's where we've introduced a 1 year lock-in period. We allow 100% foreign ownership, so there's no 4951 restrictions on our market. We are multi-currency, so you can list in dollars, in dirhams, or any other currency that you may choose. And one of the key changes we've done on the growth market is, where our main market has a sponsor and we expect a large investment bank to be acting as a sponsor, with the growth market, we've eliminated the sponsor regime, and we've introduced what the DFSA refers to as a compliance advisor, or we call the listing advisor, who will essentially play that similar role as the sponsor, and will be the key entity behind the due diligence process and putting that prospectus together. And one of the key changes with the listing advisor is, post IPO, we expect a listing advisor to also be appointed for a minimum of 3 years to assist the company in ensuring they meet the ongoing disclosure requirements. And finally, for a company who joins the growth market to move to the main market, once the company's average market capitalization over a period of 90 days hits $500 million, you'll be able to move to the main market quite easily.
Is it worth me just giving, if you go back onto that slide, just giving the if you like, just the sort of legal and regulatory issues that flash up for us? I think that is a really important slide, frankly, because it encapsulates what I literally said right at the start, is the suitability to list. Are you ready? And that is actually sort of one of the listing requirements, you know, just a suitability for listing. And then these are the sort of subsections that come through. So market cap, there's no minimum market cap anymore. So there used to be 10 million, I think, $10 million. There's no minimum market cap. Financials, the track record is very competitive now. And one of the things to say, actually, just all of these listing requirements are very competitive with other world markets, and they're very similar to what you'll see, say, for example, in London, either on the full list or AIM, the AIM market, because I think that's sort of one of the markets globally that a lot of investors are familiar with. And they sort of go, oh, is this sort of a little bit like AIM? And it's really interesting that there's features here that do pop out that are similar, which I think will give the investment community sort of a lot of comfort because it's something that they're familiar with. Working capital, we talked about that. So it's a 12-month working capital requirement. That's the same as if you were a full sort of list company, and it's obviously fairly critical. And where that comes from is actually literally one sentence in the prospectus. That's it. But it spawns a whole report from the reporting accountants around comfort on working capital. But it's critical for any sort of investor to know that working capital is in place for at least 12 months. Foreign ownership, I think, we've talked a lot about that, and there's movement around that. There's changes in the law here locally around foreign ownership limits. It's obviously something that's discussed, in the region, but, I think the fact we're already here on Nasdaq Dubai is great, so it's not even a discussion point. The listing advisor, that's very similar to the AIM approach, where you have a nominated advisor, which you actually have to have a nominated advisor on AIM at all times. So this is actually sort of slightly more flexible. And obviously the DFSA may say you've got to keep your listing advisor sort of above and beyond the 3-year period. But, I think the point is that the company should have matured sufficiently that it just doesn't need that support of an independent third-party advisor to help it comply with all of its ongoing obligations. So the listing advisor piece is what I think is very innovative, and it's good to see. And it's innovative, but it's something that a lot of global investors will be comfortable with as a concept. The free float, that's the same as the London Stock Exchange, for example, 25%, which is great. Corporate governance. Obviously, it's, ESG investing is a huge issue for asset managers around the globe. And getting that G right is critical because, frankly, investors are not going to buy in if the corporate governance is not robust. And, one thing to be very clear is the corporate governance requirements for if you like, the sort of the main list on Nasdaq Dubai is exactly the same for the growth market. So it's thorough is the way that I would call it. It's thorough but fair. It's not too onerous, but it's familiar concepts again that you would see around the globe in terms of the various committees and independent non-executive directors and the like.
It's probably worth pointing out that that's probably one of the main changes that most companies that then go on to list have to undergo if they're not already involved with venture capitals or PE houses. That sort of oversight, non-independent directors can be the sort of main change that you have to make to be able to list and to be ready to list.
Absolutely, and because your board has traditionally been made up of the founders, and then they may not necessarily be independent, most likely not. So, that's not going to comply with corporate governance requirements going forward. And so, Anna's absolutely right. That's probably one of the things that you should get right earlier and sooner rather than later, because it is difficult sometimes to comply with it, and you don't want to be doing it right at the time of listing. That's another thing, and we'll talk about that in the process. But don't do it on listing day. Try and live the system. You should have a corporate governance architecture, an environment that you've created, and would be great if you've actually operated it for maybe 2 years. I mean, it's not a must do. I mean, you see, even companies going on to the biggest exchanges around the world, they will change the board at the time of the IPO. So, it's not sort of mission critical, because you can do it at that late stage, but try and do it as early as you can. Bed in that board, get them sort of just moving in terms of regular board meetings and just getting into the process about internal reporting, etc. So and the lock-in, again, generally speaking, this is a regulatory lock-in, but there's commercial lock-ins that the underwriters and banks would usually require anyway. So, which is effectively, if you do an IPO, the underwriters don't want to see, obviously, a dumping of stock in the market and creating a huge overhang and obviously pricing issues as a result. So, there would pretty much normally be in an underwriting agreement a commercial lock-in anyway. So, or an orderly market provision. So, frankly, that's not an issue. The currency obviously is great, and the passport to the main market again is critical for ease of use. So.
Okay, excellent. So if we just quickly look at the listing process and look at key activities, we can spend hours going through the process and what needs to be done. But we've kind of split this up into 4 key areas. You've got the preparation, you've got the legal and regulatory process, you've got the investor engagement, and then the actual go-to-market where you're going out and raising money. I know you're going to be speaking about some of the key processes later on, so I'm not going to spend too much of this time, but I'm going to come back to that point around what you made, being ready, that you need to be ready to IPO, and that's where preparation is very important when it comes to the listing process. And investor engagement, you don't wait until you've got the prospectus approval and then you go and do the roadshow. It's very important for you to start speaking to investors at an early stage and start getting feedback from investors, which is where your advisors would take you on early look roadshows. You'll do presentations to analysts because it's important to get feedback from analysts as well. So you'll be doing that investor engagement at different points of the process of doing the IPO in preparation for that go-to-market where you're actually going and doing your roadshow and meeting with investors with the hope that they'll put some money down on the table. The IPO team.
Yeah, sure. Okay, so if you can actually just flip back to the previous slide. I mean, I think it's just worth saying that it looks like there's a lot of elements there, and there are. Conducting an IPO is like literally conducting an orchestra. There's a lot of moving parts and there's a lot of challenges, but one of the things you can see just on the left-hand side of the screen is the advisor introductions, and we'll move on in a tick. But getting the team right is absolutely critical, and there are quite a few moving parts within that, and you'll see in the various stages throughout the IPO process. You've got a lot of people doing a lot of things, and one of the things is actually the management itself. You've got to run the company at the same time, and there's a lot of things that you've got to be doing on that slide. And it seems to me sort of it's worth making sure that you manage expectations. There's a lot to do. Timetable. I don't think actually we've got a slide around timetable, but again, we're constantly asked, well, how long does it take to list? And it's sort of one of those things that without a doubt, the key is, again, this point around readiness. And, the better prepared you are, the quicker it's going to take, is the simple answer. Where we see in reality is 6 to 12 months. It's 6 months if you're very well prepared, or maybe 4 to 6 months. 4 to 6 months if you're very well prepared, and then that can go out to 12 months. But that's also dependent on the state of the market as well. I mean, that's from if you like, a legal and regulatory and process-driven sort of timetable. But you are beholden to the market, and so when you see that companies maybe haven't come to the market when they announced that they would. It's not necessarily because it's taken so long to do all these things. It's because, the banks have said, look, it's just not right at this point in time. And obviously a classic case in point is around COVID. It must have been terrible if you were about to launch your IPO kind of in March this year, and then suddenly, everybody's disappeared. It must have been very difficult. So, a lot of things get mothballed, and frankly speaking, that's quite common, and you are beholden to the market. But that's really just to be very upfront and manage expectations. And there is a lot of work and there's a lot of time involved, but at the end of the day, you are driven by the market and the investors, and so that sort of investor engagement piece is very, very important. The legal and regulatory, that just drives its own process, but the investor piece is just so important, because that's how who you're going to market the IPO to, and is the market receptive at this point in time, or is it worth finding a better window? So those are the sort of things to think about in terms of the length of timetable on the listing process. So so the partners for the IPO, I mentioned this concept of getting the team right from the start, and I remember talking to it was Noor Swed from DEPA. So DEPA is listed on Nasdaq Dubai, and in 2009, I think 2008, 2009, and she said that the critical bit was actually to have chemistry between the team members, because as you can see, there's 8 moving parts there already, and all of those people have got to get on. You're moving towards the same goal. I mean, as a lawyer, I always wanted to be a M&A and capital markets lawyer, because you're moving all towards the same goal. It's not litigious, not contentious. We're not trying to fight each other and bust each other up. So, you've got a common goal, but everybody has their particular requirements and things that they need to do. But you've all got to basically have that chemistry and that real sort of objective of doing the deal as quickly as possible, but efficiently and correctly. So it's worth just going through who the sort of the dramatis personae are on an IPO. And there are others as well. You can sometimes find that you get a market consultant who comes in and gives an overview about a particular sector, because you're going to be preparing a prospectus, which is basically your main marketing document, and you might want to put in there some very specific information about the market in which the industry is in. And so there's other players beyond this, but these are the main players that you'll see on every IPO. So you've got the company itself, and one of the things that we would recommend right from the very outset is just make sure that the board unanimously is in approval to proceed with the IPO. And that sounds an extremely simple thing to say, but there should be a board meeting in which there's a unanimous resolution that the whole board is aligned and wants to go forward. And then we would absolutely recommend having an IPO committee. So an IPO committee of the board that effectively is the liaison between the company and all these other advisors that you see. So you get a dedicated committee that is responsible, is reactive, proactive, and is the point of contact for all of these advisors to come into the company. Because if you start firing emails to the chairman, the CFO, the CEO, everybody's just answering a ton of questions, which could be repetitive as well. So the other key thing about the company is the opportunity cost of management time. The company needs to keep trading. There's going to be a ton of people asking the management about the IPO process, but you've got to have the company in the right shape for listing. So it's trying to be efficient with the board and with the company, so as to make sure you don't compromise the actual trading of the company itself. You'll need a bank or broker / underwriter. They're a critical, really critical player in this whole system, because essentially they bring the marketing and the investor side to the whole process, but they'll also quarterback the whole deal. The main investment banks that do this, they've done it all before, and there's a process drive to it, and trying to keep everybody kind of on track. But most importantly, they are there to effectively sell the IPO and to bring the book of investors. The listing advisor. Now, this is obviously something that is new to the growth market, and technically speaking, the bank broker underwriter could be the listing advisor. However, I think the way that the market is going to develop is you will have listing advisors who take that role, and take it because it's a 3-year ongoing role. So it's different to what the bank and broker underwriter would do, which is usually sort of come in, speak to the company, conduct your IPO. Obviously, they're still invested with the company itself, but you don't necessarily want to have a compliance team within the bank that's looking after a company for 3 years. They may decide to do that, but that's a market development, and I think you'll see different advisors coming in to take that listing advisor role, which I think is a good development for sort of a sophistication in the market and a development in the market, because the more there are sort of players out there to support issuers, the better it is, frankly.
And this is where we are working with a lot of boutique investment advisory firms here, not just here in the DIFC, but in the UAE, to be able to play that role as the main listing advisor.
Yeah. I think it should be encouraged. There's no doubt, and please do the more the merrier. So please, do inquire about the compliance advisor role. I mean, at the end of the day, you have to be approved by the DFSA. A compliance advisor within its own licensing within the DIFC needs to make sure that it can actually fulfill the role. But then you obviously get approved by the DFSA ultimately to fulfill that role. Legal advisor to the company, and obviously the company itself has its own lawyers, but also the bank broker underwriter will have its lawyers as well. So 2 sets of lawyers. So lucky for lawyers, it's good. Lawyers love IPOs. There's lots of us, and the more the merrier, which is absolutely one of the reasons we're certainly encouraging the market. It's good for business. Obviously, Nasdaq Dubai and DFSA for the growth market is absolutely critical. It is a team, and it is a relationship, and for me, having that good relationship with the FSA and Nasdaq Dubai and keeping them very much involved in your process is actually really important, because you can hit the hurdles a little bit earlier if there's any issues from a regulatory or exchange perspective, and it's good to head them off as soon as you can. So keeping that communication with Nasdaq Dubai and DFSA, I think is really, really important. The reporting accountants and auditors, obviously, in the prospectus itself, you have it could be 1 year financials, but usually you would have 3 years financials if they're available. So you have accountants who will basically do financial due diligence, look at working capital, financial reporting procedures. Also, PR advisor. Not every IPO necessarily needs a PR advisor, but it's recommended. It is part of the ecosystem, and it's one of those things that when you're actually going to market, looking at the investor education piece, it helps to have your PR advisor. So that's that slide. So the listing advisor's role. Really, this is sort of 3-stage process, I think, and this is where the compliance and listing advisors need to get their heads around sort of what actually are they going to be doing, and I think it's getting in early, sort of around that sort of readiness piece, which is really alongside, I would say, the lawyers. I would say this, but bring the lawyers in as early as you can, and bring your compliance advisor and listing advisor in as early as you can. I think the way that it will work is the compliance advisor will be the particular liaison with the DFSA. So the DFSA likes to have only one point of contact in the whole deal and IPO team. And if it's a main list, that would pretty much usually be a sponsor. So effectively, the compliance and listing advisor would become what is effectively the sponsor role, and would be the key liaison with the DFSA. And obviously that is around making sure that the company is suitable and it's complied with all the eligibility criteria, and just going through, if you like, the application process that's required for the DFSA and for Nasdaq Dubai. So that's quite a lot of form filling. That's quite a lot of documents that need to be submitted. So it's good to have somebody who is in complete charge of that, and that will be their sort of focal point in terms of getting to the actual listing. And then I think probably their most important role is the post-IPO bit. You know, a lot of the other advisors, the banks, etc., they will be very much pre-IPO and IPO process driven. Everybody kind of knows their role. But the post-IPO bit is when, you know, in a way, the company flies and it has its growth opportunity. And it's great that there's a set of stabilizers there to just make sure that it, you know, for at least 3 years, it goes nicely straight and complies with all of the ongoing continuing obligations under the admission disclosure rules of Nasdaq Dubai and also the DFSA's markets rules. So the listing advisor will be key, and I think that 3-year process is particularly important. So from a legal and regulatory side of things in the listing process, just to give you a bit of a flavour of what we would do as lawyers. I know that it's probably not the most interesting for the listeners, but this is what we do, and if it's not the most interesting, at least we can enlighten you as to what we do, and then you don't have to sort of worry about it again. But the first part of the process really is legal due diligence, and I think what we do is, I would actually almost put there's a pre-legal due diligence where we work with the issuer around their eligibility requirements, and that usually involves meetings with Nasdaq Dubai and possibly even the DFSA right at the outset, just to work out at a very high level, is this going to work? Is this going to fly? But then the legal due diligence process itself is a deep dive into all of the sort of contractual documentation of the company, and effectively, you know, it's really there to see if there's any barriers or impediments to the whole process. But it also allows the lawyers to understand what are the key risk factors in the company, what are the issues, you know, can we verify what we're saying in a prospectus, which is a marketing document? You know, the due diligence allows us to sort of underpin sort of all the other processes, if you like.
I think it also comes slightly down to readiness again,
yeah,
as to how much work the due diligence will really involve.
Yes.
Because, you know, if the company is ready, it may have already protected all of its intellectual property, for example, or it may have already made sure that it's got contracts in place on appropriate market terms with all of its suppliers, customers, or whoever. When all of this is in place, the legal due diligence is much shorter because everything is there. It's more of a checkbox. Yeah, they've got that, they've got that. When companies are not ready, there is a much sort of deeper investigation that needs to be done. It takes up more management time whilst the lawyers effectively dig into the issues that, you know, that are there at the time.
Yeah, and I think that's we'll come on to that actually, because that's the next slide. But I think just on the previous slide, just to finish off, we corporate governance, again, that comes out of our due diligence process, because we'll see how the board is made up and how they run their board minutes and board meetings and shareholder meetings, etc. And then the investor and education and marketing, and that's more sort of where the bank and brokers sort of get involved. But obviously, from a legal perspective, we just have to make sure that what they're saying in any sort of marketing materials is exactly what will be in the prospectus, and that we can say it's properly verified, and it sort of complies with any other sort of content requirements. So just onto due diligence. We have pretty much sort of covered this in a bit of detail already, but it's just worth going into just a little bit more detail. I think in section 2, it just gives you an idea of the things that the lawyers will be really focusing on. I think I'm going to pick out sort of 2 particular ones, and that is if there's bank financing, etc., or even a debt piece, a debt capital markets piece. Are there any breaches of financial covenants by going through the listing process? Because quite often, you know, the founding shareholders might sell out a certain proportion. Are there any restrictions around that? Does that trigger any covenants? And obviously you don't want to get into a position where, you know, you list and then the bondholders say, well, you can't do that. It's highly embarrassing. And I'd probably get fired as a lawyer if I didn't spot that. So those sort of things, and it's worth actually saying that as a part of the due diligence process is remedial action. Because where we see issues coming out of all these elements, we obviously recommend to the company, well, no, you need that, like it's vital to do this before you IPO, or it's sort of, you can deal with this after the IPO within 6 months to a year or whatever. It's not a sort of crucial to living type point. But it's just looking for any sort of barriers to the IPO itself. So making sure that, you know, if you need some consent or you need any waivers, you go out and get them and do it in good time. And so it flushes out these sort of issues. The other element of due diligence, which is not for the lawyers, but is for the reporting accountants, is a full financial due diligence, which again looks at the financial health, if you like, of the company, and then focuses on two main elements as well, which is working capital, financial position, and prospects procedures report, which I think is very critical to talk about the FPP report, because that is key for understanding the internal structures around financial reporting, which as a lawyer is then critical, because we want the company to be able to comply with all of its continuing obligations once it is listed. And essentially the main one is disclosure of price sensitive information in a very timely manner. So you've got to know what is happening in your business on a timely basis, so that it allows you to make the disclosure to the market in time. So that report to me is like a real health check as to how the company internally are its guts right? Does the plumbing work? Is the way that I would look at it. Okay, so then we'll look at the prospectus. So Anna, do you want to just talk a little bit about the prospectus?
So as Andrew's already said, the prospectus is the main marketing document. It's also the formal offering document. So it does have to be approved by the DFSA before it's formally issued. It's basically the document that includes everything that anybody would ever want to know about this company to decide whether to invest or not. So it will have information about the business of the company, when it started, what it does, how it's sort of improved on what it does since it started. It will have an operational financial overview. It will have information about the securities being offered, so whether it's just equity or, for example, exchange traded funds or other type of funds. It'll have information about the assets of the company, obviously depending on the business of the company. That may be primarily, if it's tech related, it can be primarily sort of all around intellectual property, or it can be, more around machinery, equipment, anything innovative, very dependent on the business. As Andrew said, it will have financial information. This will hopefully in the growth market be sort of a much smaller section of the prospectus, where companies are coming with less of a financial history. There'll be provisions around the terms and conditions of the listings. So, how much you can invest, how much would you want to invest. It will have information around the management of the company. So what is their experience? What's their background? What's their academic qualifications? And this again comes into the corporate governance piece, because the management of the company prior to the IPO may have all been founders who all have particular business experience in that particular field. Then there may also, or there will have to also be independent directors, so they will have potentially different qualifications, maybe more financial based, or again, experience in the field. And there'll be information about the admission, when is it planning to happen, what the process will be, how you are able to invest in the company and when. There'll be information about the existing share capital and the proposed share capital, so that all the investors will be aware of, the change in capital after the admission. So, how much people are effectively being diluted, how much is being offered. And then a substantial section of the prospectus is the risk factors section. So these sort of vary by business, but there are some standard ones, such as any jurisdictional issues. There's usually a section on sort of large competitors, and a lot of what goes in this risk factor section is what will come out of the legal due diligence and the financial due diligence. So as we keep going on about, the more ready you are, the shorter your risk factor section should be, and then the shorter the prospectus should be.
Yeah, absolutely.
There will also be a section on classes of securities. So, for example, if it was shares, will they have voting rights attached? Will those voting rights be even across all of the classes of shares, or will the founders be keeping any different classes of shares with more substantial voting rights? It really is the sort of be-all and end-all description of the company, the risks of the company, and basically the decider of whether to invest or not.
Yeah. And from a practical perspective, essentially the lawyers will really kind of quarterback the whole drafting process, but all of the different players will add in and comment and look at their various elements. So, things like around the OFR, Operation Financial Review, the financial information, that'll be kind of reporting accountants, equity story, information about the issuer. You get a lot of information around that from the bank or the underwriter or the compliance listing advisor. And then, generally speaking, it's then got to go to the DFSA, and the DFSA have to approve it. And the way that this process works is it's a to and fro between us and the DFSA, just around they comment whether the things that they need clarifying, and then we obviously address that and resubmit. So it's an iterative process. So it's very practical. I'm conscious of our time. We're getting towards the end, but probably one of the most important slides towards the end, as ever, just to kind of keep you on your toes. But corporate governance and continuing obligations, I think this is obviously a critical element from an investor perspective, because you're seeing in the market, particularly in the Middle East, there have been some fairly interesting corporate governance challenges, whether it's in the private equity space or in the listed space. So I think that this region itself has to be, the best of the best in terms of corporate governance and compliance thereon. As I said, as a general rule, the corporate governance requirements are very, very similar to what you would see, particularly, say, in London. So, there's nothing abnormal there. There's nothing too onerous, and there's nothing lax either. It's a corporate governance architecture that's robust, and frankly, it's able to be adhered to, I think, with a certain degree of seriousness. Essentially, the board has to control the decision making of the company, but you would have committees on that board to delegate responsibility. So audit committee, nomination committee, and remuneration committee. You also have to fill out the board with the third non-exec directors. So you're getting that balance between executives and non-execs, and also you need at least two independent directors who are also non-execs. So from a practical perspective, it's quite difficult to find independent directors, because a lot of investors here, or potential directors, have interests in a lot of companies. It's just the way that this sort of the UAE market works. So trying to find independence is actually quite difficult. Disclosure of price sensitive information, we talked all about that just before, but that is critical as an ongoing obligation, and that's where your listing advisor will help the company itself. You've got to keep close. I think, for the listing advisors that are thinking of potentially doing this, they've got to really think, well, how do I keep track with my company? And how do I liaise with my company? How do I understand what's happening with them? And how do I get them to tell me things? because it will be the compliance advisor, the listing advisor, to effectively make sure that it pushes out that price sensitive information. So just thinking the mindset is around disclosure is a critical piece of any listing. So growth market, non-growth market, it's that mindset that you have to disclose to the market material events in your business.
But that's not events that might give something away. So if you're signing a very important contract, you're not going to tell the market you're signing a contract where competitors will find out about it. You sign it and then you tell.
Yeah, and the timing of any disclosure is obviously critical. I mean, you can actually apply to the DFSA to delay disclosure for if there is a really detrimental effect of the disclosure. Would it impact particularly on negotiations or the company if there was a disclosure? So you can actually go to the DFSA for delay, but that doesn't really happen very often, because at the end of the day, if it's material, it needs to get into the market. And that is the downside of going public in a way, is that the market will know a lot more information about you. But if you're confident, if you're ready, if you're competitive, if you're suitable, then it shouldn't be a problem. It's that's the way to approach it. I think then it's worth going on to the next slide. The way that we've approached this slide, the way you should sort of look at it, is when the banks or the brokers and underwriters go out to the market and they go and speak to potential investors. Effectively, those investors on a roadshow could ask you anything. And these are really the main bullet points of things that investors are particularly looking at. And the way that I would like if you're an issuer out there, to look at these things is, well, with my company and what I'm doing, what I'm proposing to do I have a good story to tell on all of these elements? And, the point is that you need to be strong on all of these elements. And so it all ties back into the suitability, because if there's weakness in any of these, then you're probably not suitable. I mean, there's obviously nuances there. So a classic example would be dividend expectations. One of the things that you have to really think about when you go public is there's long hold investors that just, they're in it just to see growth stories, so they don't mind if dividends are reinvested into the company, because they're going to hold that stock for 5 to 10 years. They want to see a growth story. You'll have some short-term guys who just want to get in there for a dividend and get a payout and then be off and out. And so every investor has different expectations. So you can't keep everybody happy, but I think the idea is that across the board with these elements, you're creating sufficient demand for the stock at the IPO. I think the one critical piece that comes out here is valuation, because it is a sort of, valuation is a subjective exercise. It's an art form, and the valuation is obviously key, and you have different pressures and demands around valuation. Because if you're a founder and you've lived, eaten, breathed a company for 5-10 years, and it's your baby, and you think it's valued at through the roof, but the banks or somebody objective or investors might have a very, very different view of that. So the valuation tension is quite difficult, and is something that you need to manage early on, because some companies just believe that it's highly overvalued. But that has a real impact on this part of the IPO, because if you go with an extremely high valuation, the chances are that you'll get low demand, and that you won't get enough investors to buy in at a certain price, and then you're jeopardizing actually the success of the whole IPO. But also, more importantly, once you're then into the market, the pricing and the valuation of the IPO is absolutely critical, because if you go at the high end of your pricing or a valuation that's extremely high, it's sort of in the market, in the aftermarket, once you've actually sort of listed, there's not a huge amount of scope for the price to increase. And one thing that investors like to see is, as soon as you've listed, is the price to go up. and it's a success story, investors are happy, all the rest of it. But if you price right at the top end, then there's not much scope for that growth. And so, there's certainly a tendency that you should leave something on the table. And if you're in with the mind that, you want to just quickly exit, IPO in, exit straight out, then you're taking a bit of a risk on the pricing and sort of in the first few weeks. But if you have a view of trying to attract longer term institutional investors who are going to invest, over, matters of years, then there's nothing wrong with having a slightly lower valuation, getting them in, and then the value, then hopefully your price will, as the company performs, will just keep going up and up and up. And the investors will be very happy over a longer term period and not just a quick boom bust type situation. I think that we'll probably run out of time.
We're actually on the last slide. I'll quickly run through this around why IPO, what are the benefits of going public. And obviously the first thing that comes to mind is raising capital. When companies need finances, they look at IPO as an option. But it's not just about raising capital. IPO really does give a company credibility. And we always say it's that kind of next stepping stone for a company when it comes to growth. It's the brand awareness, it's the credibility IPO brings, the competitive advantage as well. There are a lot of companies we speak to and they say, the reason they want to go for IPO because some of the tenders they want to go for require public listed companies only. And then, of course, there's others. There's employee engagement and stakeholder engagement. How many companies that are listed offer share options to their employees and their employees are remain with them for a long term because they have these share options, but also allowing your vendors and your customers to be able to get benefit from the success of your company as well. So always look at the benefits of an IPO, not just from a capital raising perspective, but other aspects as well. And that's our last slide. And I'm going to try and, I know we're past our time, I'm going to try and look at a few questions that we've received. I want to start with one question that we all get asked by companies that we speak to, and that is the fact that do they need to be present here in the DIFC or set up in the DIFC, or for international companies here in Dubai for them to list on Nasdaq Dubai?
No. So, it's an international market, and, there's multi-currency denomination listing available on Nasdaq Dubai. So, you could have a dollar denomination, you could have a business that's outside of the region that'll come in and use the exchange. So, a corollary of that is, you see sort of some companies from here listing on London and going that way. There's absolutely no reason why it can't come this way. And interestingly enough, just as market perception, we're seeing a few quite interesting issuers that are looking from the US or the UK actually, and looking to list into here, whether it's either a secondary listing or a primary listing. No is the answer.
And one of the other things is also free zones here, because there's a lot of great companies in the free zones who are ready to IPO. And one of the things we did with yourselves and Jabza a number of years ago was allow companies based in Jabza to be able to list directly on a stock exchange, and that's where they introduced the PLC category. And I know you've been very instrumental with working with Jabza and DFM on the project to allow free zone companies to list on the onshore market as well there. So although there have been restrictions, these are changing in the free zones for free zone companies to be able to list directly as well.
I think that's actually a really pertinent point, because one thing to mention is there's a huge recent development, which I think is slightly gone under the radar, but effectively ESCA has changed its offering rules to allow for free zone companies to offer securities and list on the DFM. Now, what that has highlighted actually, and will be a big benefit for Nasdaq Dubai as well, is Nasdaq Dubai has always allowed free zone companies to list. And as you rightly said, JAFSA changed its regs in 2012, I think, to allow for public companies within their corporate sort of regulations. So the the constraint with the free zones is not actually with the exchange or with the rules of the DFSA. It's actually that a lot of the free zones don't have within their own corporate regulations the facility for public limited companies. So really what needs to happen, and it will hopefully come as a result of the development on the DFM, is that a lot of these free zone the free zone entities themselves will actually change their free zone regulations to allow for public limited companies, which will allow them to list on either DFM or Nasdaq Dubai. But I think the point is that, you know, for example, JAFSA does have those corporate regs in place. JAFSA codes could have, since 2012, listed right here.
Directly. Good. There's a very interesting question coming around privately run companies having fear of losing control over its enterprise that they nurtured and created.
Yeah.
And that's something we have a discussion with every company that we speak to around that aspect of, are you going to lose control or not?
Yeah, yeah. So it's a critical question, obviously, and it's a passionate question because, you know, a lot of founders don't necessarily want to lose that control, but it's actually a balancing act. I mean, one of the key eligibility requirements is for a minimum free float of 25%. So effectively, 25% has got to go to the public. Now, if you look at that from a corporate perspective, what that means is that you know, effectively you're looking at maybe selling out or having a shareholder base that's not the founders of, say, 25 to 30%. Now, effectively, in terms of corporate law, depending on where the company is actually incorporated, but essentially to pass special resolutions, you need 75%. So quite often you'll lose that ability to pass special resolutions. And that's the whole idea of having 25% free float, so that there is, if there's a supermajority effectively required, then you have to go to the minority shareholders to make sure that they're involved in the decision-making process. So the control piece is actually very interesting because there's a little bit of conflict between corporate governance and keeping control. And investors want to see good corporate governance and less control, if you like. Founders want to sort of keep control. So it's getting that balance where the founders sort of can let it go to a degree, but they can keep control. So what you will see is, you know, say for example, keeping over 50%. So, you know, then you can pass ordinary resolutions just by your own shares. So if you're keeping 51%, then you can effectively pass ordinary resolutions. So you're keeping control in that way. And then, you know, generally speaking, you know, you'll be represented on the board, etc. But essentially, there won't be a shareholders agreement like what you would have as a private company, which gives things like rights of shareholders to appoint directors. That all falls away because that's not good corporate governance. You know, you're trying to get away from that. But what you will find is that major shareholders will have directors on the board. That's sort of just the way that it works. But I think, you know, the point is, it's a balance between ceding some control, making sure that you've got good corporate governance, but keeping some form of control just by keeping a large stake in the company. But, you know, the founders have got to try and have two hats. They've got to really think of their own sort of control piece, but they've got to think that minority shareholders who will have had nothing to do with the company, all of a sudden are parting with their cash to take a share in your company. You know, you've got to look after these guys, and they're the minority. These guys don't know anything about the business. You're running the business, and then they've come in and put their investment in. You know, keeping an eye and keeping your minority shareholders happy is critical. One thing that the regulator is very, very keen on is to make sure that those minority shareholders are protected, and will go to the mat to do that. So if you do it yourself and change your mindset to make sure you're keeping an eye on your minority shareholders, first of all, you're not going to run foul of the regulator, and the minority will be happy, you know. And so it's a balance.
Good, excellent. So we are short of time, and then we do need to close the webinar now. Any final comments from yourselves?
I think really the only thing that I would just reiterate, you know, is just readiness.
Yeah.
And you know, it's sort of suppose it's like, you know, looking at young football players that get thrown in as teenagers, and the great managers, Jurgen Klopp, etc., Guardiola. If they're ready, they're ready. And I think, you know, if your trading history is 1 year, but you've got really strong management, good corporate governance, it's been set up properly, it's ready to go. And then it's suitable for listing, and the DFSA will be happy, you guys will be happy as Nasdaq Dubai, and then investors will be happy. And, you know, the thing that we're all trying to strive for is that sort of, you know, avoiding that terrible situation where, you know, in 2 to 3 years' time, it's very clear that it was not appropriate. That's no good for anybody. So I think that readiness and suitability is key, and start as early as you can.
And it makes the whole process easier as well. And on that note, look, it's important to understand the full process, understand what readiness means, what the requirements are, what you're going to need to do throughout the process. And to do that, feel free to reach out to, you know, either ourselves at the exchange or the Andrew and Al Tamimi. And on that note, I'd like to thank you all for joining us today. Thank you, Andrew. Thank you, Anna, for your input. Very helpful. And we hope to see you on our next webinar. Thank you very much.
Thanks, Tahir. Thank you.
Thank you.